The fundamental error in the perception of capital lies in a deeply rooted human tendency to reify success. Most people ignore the true nature of wealth until it becomes too late to change anything. A distorted view has firmly taken hold in the public consciousness that the struggle between securities and real estate is merely a question of yield. However, the very framing of this question is fundamentally flawed. Such a comparison is akin to trying to determine which tool, a hammer or a saw, builds a house better, while completely ignoring the figure of the person holding that tool. The layman confuses the means of achieving a goal with the operator of the system, and this conceptual confusion costs humanity more than any other mistake in the history of personal finance. In the mid-1970s, a natural experiment began. Two subjects possessed identical starting capital of $75,000, a colossal sum at the time. One bet on the physical world, purchasing rental real estate in Los Angeles. The other chose the abstract world of equity, in enterprises with powerful economic moats, investing in companies like soft drink manufacturers and confectionery factories. After 40 years of biological time, the first subject found himself in a state of permanent stress, still resolving issues of building maintenance and tenant conflicts. The second lived in a state of absolute peace, having achieved wealth through a complete absence of outward action. The tragedy of the first investor was not a lack of profit. His property had grown in value, he collected rent regularly, and even scaled his operations using leverage to expand his influence. The mistake lay in ignoring the mental and emotional costs that never appear in standard yield tables. A physical object creates an illusion of control. It can be seen, touched, improved, or personally managed. This sensation of active engagement is perceived by the brain as something productive and correct, while owning index funds seems to the layman like a passive, almost lazy state, devoid of true investment meaning. However, the system is designed such that excessive activity is the primary enemy of returns. The stock market is a mechanism for redistributing resources from active units to patient ones. This statement is often perceived as merely decorative, yet few are capable of truly integrating it into their strategy. In reality, the investor who makes the fewest touches makes the minimum number of decisions and almost never disturbs their asset, eventually accumulates a significantly larger volume of capital. The human mind, conditioned to believe that in sports or business, the result is directly proportional to the effort expended, refuses to believe in the effectiveness of inaction. Investing is a unique field where endurance, not diligence, is rewarded. It is here that real estate turns into a dangerous trap for the majority. It generates a destructive illusion that the owner's personal contribution adds value to the object, when in fact, it only increases operating expenses and cortisol levels. If we turn to cold mathematics, from the mid-1950s to the end of the first quarter of the 21st century, the index of the 500 largest companies showed an average annual return of about 10%, assuming dividend reinvestment. This figure seems mundane and boring, but over 30 years, $100,000 placed in this boring mechanism transforms into $2 million with zero intervention. During the same period, the residential real estate sector in most regions demonstrated a nominal price increase of 3% or 4% per year. Certainly, using debt and collecting rental payments adjusts this figure. But honest accounting inevitably faces maintenance costs, taxes, insurance premiums, and management fees. When the calculation includes the value of the owner's time, their nervous exhaustion, and the opportunity cost of capital frozen in down payments, the real return on real estate fluctuates between 5% and 8%. This is a satisfactory result, but it fatally loses to the reliability of the market available to those capable of simply doing nothing. The complexity of the situation is exacerbated by the fact that examples of rapid enrichment through housing often become public knowledge, creating a survivorship bias. People remember those who bought land in California 70 years ago, but forget those who bought shares in successful corporations in the late 80s and earned millions with incomparably less stress. The question is not the theoretical possibility of getting rich, but the system's ability to forgive operator errors over 30 years. Most investors in walls are ruined not by the market cycle, but by a cascade of minor psychological and operational failures that tend to accumulate. The excessive use of borrowed funds to maximize profit inevitably leads to a collision with reality when interest rates rise or vacancies appear. In such moments, the owner is forced to inject additional funds into the system just to keep the asset afloat. Due to the low liquidity of real estate, it is impossible to exit a position instantly, just as it is impossible to gradually reduce exposure to the asset. This trap has destroyed many intellectually developed and hardworking people who underestimated the level of demands imposed by physical property during times of crisis. The best strategy is one that doesn't require a person to be constantly brilliant, but only mandates that they don't commit fatal follies over a long period. The fundamental difference between owning square footage and owning shares in a business lies in the very structure of human participation within the system. When a subject invests in shares of a high-quality enterprise, they are effectively hiring thousands of professionals who work daily to increase the value of their capital. The CEO wakes up thinking about profit growth. The finance department optimizes taxes. Operational teams increase margins, and sales departments aggressively capture new markets. This entire colossal volume of intellectual and physical labor occurs autonomously, requiring not a single second of the shareholder's personal time. Here, the investor acts as a passive beneficiary of someone else's efficiency, which is not a weakness, but the highest form of strategic superiority. In contrast, acquiring rental real estate instantly turns an investor into a multitasking operator. They simultaneously become the CEO, financial controller, customer service manager, and often the emergency repairman. Any problem, from a roof leak to a legal dispute with a tenant, requires their direct involvement, or, at the very least, strict control over hired personnel. This state cannot be called passive income. In reality, it is a second job that imposes obligations on a person comparable to a full-fledged business, but often without the corresponding entrepreneurial margin. The irony is that most people, when calculating returns, completely ignore the value of their own hourly rate, creating a false sense of profit where, in fact, they are merely selling their time at a discounted rate. The mathematical singularity of this process becomes obvious upon a detailed analysis of a long-term horizon. If we consider a property worth $500,000 purchased with a $100,000 down payment. At first glance, the cash flow seems attractive. However, with honest accounting of property taxes, insurance premiums, building depreciation, management fees, and inevitable periods of vacancy, the net remainder shrinks to $12,000 per year, Meanwhile, the same $100,000 placed in an index of the 500 largest companies with an average return of 10% generates a comparable amount in the very first year, without requiring a single phone call, a single decision, and while maintaining absolute liquidity. The difference becomes catastrophic after 20 years, when the stock portfolio grows to $670,000 and begins to generate an annual income exceeding the initial investment. The real estate owner remains tied to operational problems and a complex exit procedure. The stock market system possesses a unique property of internal capitalization. The world's best corporations are endowed with what professionals call pricing power. They are able to pass inflationary costs onto consumers, smoothly and almost imperceptibly raising the cost of their products, whether they are beverages or technological devices. This process happens organically and scales globally. A real estate owner's options are limited by the local market, legislative acts on tenant protection, and the physical condition of the property. Even with a sharp rise in the cost of materials and services, a landlord often finds themselves locked into old contracts or the price expectations of a specific neighborhood, creating a dangerous lag between rising expenses and rising income. The psychological resilience of the system is also unevenly distributed. In moments of market turbulence, stocks may lose 30% of their value, which causes discomfort but does not require immediate action. Companies continue to function, factories to produce, and people to consume. If the investor remains calm and does not attempt to flee, the market inevitably recovers, rewarding them for their patience. In the case of real estate, doing nothing during a crisis is physically impossible. Mortgage payments, taxes, and maintenance bills continue to arrive regardless of the property's market valuation or whether the tenants are paying rent. This forced activity under stress often becomes the point of failure, compelling investors to liquidate positions at the most unfavorable moment when capital is most vulnerable. There is also a dangerous misconception regarding the tax advantages of real estate, which are actively promoted by the seminar industry. While depreciation and mortgage interest deductions are real tools, the stock market offers equally powerful mechanisms. Long-term holding allows for the deferral of tax liabilities for decades, and the ability to harvest losses or benefit from a stepped-up basis upon inheritance makes the tax burden on stocks comparable or even lower in the long run. True wealth is not that which requires constant control and operational intervention, but that which is capable of increasing in volume while its owner sleeps. Corporations work 24 hours a day across all time zones on the planet, whereas the success of real estate depends on whether a pipe bursts at 3 a.m. or whether the municipality changes zoning rules. The contrast between the freedom of passive participation and the burden of operational ownership determines not only the size of the account, but the quality of the life lived. The magic of leverage is the very gravitational field that pulls inexperienced investors into the orbit of real estate. The ability to control an asset worth $500,000 with only $100,000 in cash creates a dangerous illusion of multiplying the owner's intellectual capacity. In this coordinate system, five-fold leverage turns a modest 4% growth in market value into a 20% return on invested capital. However, a fundamental error is hidden in this math. Leverage is not a magical tool for creating value. It is the process of borrowing resources from one's own future to amplify the present moment. The problem is that the mechanisms that multiply profits during periods of growth maximize losses and risks with the same ruthlessness at the slightest reversal of the market cycle. In professional circles, there is a harsh metaphor. Only when the tide goes out do you discover who has been swimming naked. Using leverage is precisely that, metaphorical naked swimming. As long as the economic tide is high, the strategy seems brilliant and the investor prophetic. No, conditions always change. This is an inevitable law of financial systems. The tragedy is that leverage completely destroys the margin of safety and the right to make a mistake. Markets are inherently unpredictable, and a debt load requires the operator to be simultaneously lucky, disciplined, and insightful at every critical moment for decades. This is an obligation that is almost impossible to fulfill without extraordinary skills and iron emotional control. The stock market, by contrast, offers a path to wealth through pure accumulation that does not require the use of borrowed capital to achieve outstanding results. A diversified portfolio of quality enterprises has the capacity to double roughly every 7 years at an average return of 10%. In this geometric progression, $100,000 turns into $200,000, then $400,000, $800,000, and finally $1,600,000 over 28 years of biological time. This entire process occurs without margin calls, without the risk of forced sales, and without the need to interact with the banking system to maintain positions. Patience becomes the only necessary fuel, yet this is exactly the resource that is catastrophically lacking in most people striving for an imitation of frantic activity. Observations of human behavior over 70 years confirm a sad pattern. Individuals systematically overestimate their ability to cope with complexity and stress. They are convinced they will remain rational when the value of their property drops by a third, when tenants initiate lawsuits, or when unscheduled capital repairs require $20,000 not provided for in the budget. In reality, emotional paralysis or panic sets in, leading to a series of fatal decisions: selling the asset at the bottom of the cycle or attempting to take on even more debt to cover current losses. The fundamental difference manifests in moments of global upheaval, such as the Great Depression, World Wars, or the 2008 financial crisis. In each of these eras, great corporations demonstrated biological resilience. They adapted, cut costs, and continued to serve consumers, allowing shareholders who maintained their positions to emerge from the crisis in significantly better shape. For real estate owners, those same periods were often fatal. History remembers mass foreclosures on those who spent their entire lives acquiring property, but could not make a single mortgage payment in the midst of a liquidity crisis. Real estate recovers, but many investors do not survive to see that moment, having been ejected from the system due to a lack of flexibility. Stocks provide the investor with a tool physically unavailable in the world of real estate: the ability to average down during a market decline without increasing the overall risk of the system. If quotes drop by 30%, a shareholder can continue buying, acquiring cheaper shares in a business, while their debt load remains zero. In the world of real estate, trying to buy at the bottom requires increasing debt, expanding operational complexity, and taking on new management obligations during the most unstable period. This difference between passive holding and active survival determines who becomes the owner of a fortune and who becomes a victim of statistics. the sense of security derived from being able to touch an asset is merely a cognitive bias, an illusion of control over market forces that cannot actually be managed through painting walls or replacing kitchen sets. Over the decades, the priorities of any investor undergo an irreversible transformation dictated by the biological laws of aging. What was perceived at 35 as an exciting operational task or a challenge to professionalism inevitably turns into an exhausting burden by age 65. The energy required for the continuous resolution of emerging problems depletes, and the tolerance for stress and administrative chaos tends towards zero. At this point in the life journey, the priority becomes not just the size of the capital, but its simplicity and autonomy, making the asymmetry between physical assets and business equity critical. Real estate as an asset class possesses a fatal quality. It ages poorly along with its owner. The older a person becomes, the heavier the burden of property management obligations feels. Conversely, well-selected stocks only become easier to handle over time, as the power of compound interest accelerates and the need for the investor's attention virtually disappears. The corporate governance system allows capital to flourish for decades without a single call to the owner, while a rental business requires its creator to stay in the ranks until the very end, turning a hard-earned retirement into an endless series of minor crises. There is a tragic scenario in which a professional spends their entire conscious life building an empire of rental houses, convinced they are creating a foundation for freedom. By the time they retire, such a subject may possess significant net worth expressed in millions of dollars locked in brick and concrete. However, when attempting to convert this capital into real freedom, they find themselves trapped. The assets require constant supervision, and their realization involves colossal transaction costs and tax shocks. Realtor commissions of 6%, capital gains taxes, transfer fees, and pre-sale preparation costs can instantly destroy up to 10% of accumulated wealth. Such an investor creates not a fortune, but a prison of assets from which it is impossible to escape without serious losses. At the same time, another path, based on the regular topping up of a stock portfolio and the use of index instruments, leads to a completely different finale. By retirement age, such an investor possesses absolutely liquid capital that allows them to instantly adapt expenses and lifestyle to current needs, without having to negotiate with tenants or pay huge commissions to intermediaries. Their wealth is true because it grants the right to own time, the only irreplaceable resource. Real estate often deprives a person of this right, forcing them to work for the assets even when the body's biological resources demand rest. The deep psychological defect of an active real estate strategy lies in the theft of peace. Wealth that forces its owner to wake up at night from anxious calls or to worry about repairs and vacancies is not worth the effort spent on its creation. The true purpose of capital is the freedom to do what you want, when you want, and with whom you want. Properly structured stocks work for a person while they focus on living. For most, real estate turns into obligations that dictate a schedule and create problems requiring immediate reactions. This philosophical difference, in the long run, outweighs any on-paper yield calculations. When the system evaluates the success of a strategy after 70 years of observing human destinies, the conclusion becomes obvious. The overwhelming majority of people overestimate their readiness for multi-year management of operational complexity. They ignore the fact that at 80 or 90, the value of simplicity becomes absolute. Investing in great companies allows one to achieve this simplicity naturally, while real estate requires either heroic efforts to maintain the system from an elderly person, or a painful and costly process of liquidating an empire during the most inappropriate period of life. The final stage of deconstructing the real estate myth is the recognition that the real value of wealth is measured not by the number of owned properties, but by the degree of autonomy of human existence. Ultimately, the only currency that matters in the singularity of the life path is freedom from external coercion. The real estate industry has done a brilliant job of convincing millions that owning physical assets is the path to independence. However, statistical and operational reality suggests otherwise. For most, this path turns into the acquisition of a second job that pays worse than the main one and eventually consumes all the free space in life. True financial singularity is achieved when capital begins to reproduce itself without the participation of the biological host. Shares of the world's largest corporations represent the quintessence of this process. When a subject owns shares in companies at the level of a global beverage manufacturer or a tech giant, they own systems with colossal resistance to external shocks and inflation. These structures possess pricing power, allowing them to pass rising costs onto billions of consumers worldwide instantly and almost imperceptibly. Unlike a landlord who is hamstrung by lease terms, tenant resistance, and local legislation, the shareholder benefits from the business's adaptation to inflation in real time. The mathematical model of the stock market's superiority becomes indisputable when analyzing risk concentration. Investment in real estate almost always means a critical dependence on a specific geographic location, the health of the regional economy, and the decisions of local regulators. A single municipal zoning error or the departure of a major employer from a city can devalue an asset into which decades of labor have been poured. At the same time, a diversified stock portfolio provides the investor with protection through global distribution. Their well-being depends on the aggregate activity of human civilization, not on the state of the pipes in one particular basement. The psychological thriller of investing often ends where an honest audit of one's own time begins. The layman who spends weekends negotiating with contractors or searching for tenants to save a few $1,000s on management is committing an act of economic self-destruction. They are exchanging the most productive hours of their life for low-skilled labor, hiding this fact behind the facade of investor status. The stock market system is ruthless to the ego. It does not provide the opportunity to feel like the master of the situation through physical management, but it rewards those capable of accepting the humility of passive participation. The protocol for success here is frighteningly simple. Purchasing quality businesses through index instruments, automatic reinvestment, and a total disregard for the noise of market fluctuations. The final conclusion reached by those who have observed the cycles of capital over 70 years is that wealth should not steal one's peace of mind. Too many people turn their assets into shackles that prevent them from moving, retiring, or simply enjoying the silence. Freedom is the absence of the need to make decisions on matters you don't care about. Stocks provide this level of silence. They do not require continuous brilliance. They require only the absence of continuous stupidity and the ability to sit still while the world around is consumed by a fever of action. In the end, The choice between walls and shares in companies is a choice between the role of a warden in your own prison and the role of a free observer of the power of human creation. Those who choose the path of least operational resistance eventually find themselves richer, not only materially, but mentally. The path to wealth through securities is boring, devoid of drama, and offers no reason for boasting at social gatherings. But it works with the inexorability of physical law. Capital that does not require your presence is the only type of capital that truly belongs to you. Everything else is merely an illusion of control over assets that, in reality, own you.